China's real estate slump seems irreversible, and its downstream industries are also facing continuous bad news. According to Chinese reports, a significant downstream industry, concrete mixing plants, are closing in large numbers. After 23 concrete mixing plants shut down in last year, the industry is expected to face an even more dire situation this summer. A woman working in concrete sales expressed how tough this year has been. She said, "This year, selling concrete is incredibly difficult. We need to ensure both quality and affordability. If I don't do this job, I'll starve. So if you have any needs, come to me and not my competitors. I don't need rest. I'm a tough woman." Additionally, reports indicate that after the mass closures of concrete mixing companies in Shenzhen last year, the concrete market in Jiangsu has continued to weaken since June this year, with conditions worse than last year. Many construction sites have paused operations due to low demand, and many concrete companies are on the brink of bankruptcy. A veteran in the concrete industry said in a video,
"Guys, this year is tough for our industry. How are things on your end? Over here, we're almost at a standstill. I don't know if we can make it through this summer. I'm considering finding another path."
Just a few years ago, this industry was thriving. From 2012 to 2018, bosses in this industry were incredibly wealthy, with each concrete mixing plant attracting investments of at least 50 million yuan. These companies were highly profitable. In terms of industry status, the concrete sector is foundational to the entire real estate and large-scale infrastructure industries. As real estate declines, these foundational industries also suffer fatal blows, with warning signs already evident. The next to go bankrupt would be cement factories, gravel quarries, and transportation companies, eventually affecting the decoration industry. Looking ahead, there seems to be no turnaround for this industry in the next 20 years, with houses losing value and no buyers who would be willing to build new ones. Ultimately, the continuous downturn in the real estate sector is the root cause of the sluggishness across all industries in China, as a massive amount of cash flow is tied up in this bottomless pit. Just how deep is this real estate pit? Recently, Jiangjiakou City in Hebei Province has attracted public focus due to its rock-bottom housing prices. For 60,000 yuan, you can buy a 60 square meter two-bedroom apartment. This information was revealed by Chen Juan, a real estate agent in Jiangjiakou. She said that in the city's Xiahuayan district, a 60 square meter two-bedroom apartment costs 60,000 yuan, or just over $8,200. And a 78 square meter two-bedroom, two-living room apartment costs 80,000 yuan. There are many similar properties with legitimate 70-year ownership rights. Chen Juan also mentioned some cheap housing for sale in the Macha She residential building. She introduced a property listed for 85,000 yuan and said the seller would be willing to negotiate the price further. In the same neighborhood, some 78 square meter properties are priced a bit higher. For example, some are listed at 100,000 yuan, 110,000 yuan, and even 120,000 yuan. However, these higher prices are still significantly lower compared to previous market values. A few years ago, during the boom in the real estate industry, properties in Jiangjiakou typically started at 10,000 yuan per square meter. A 60 square meter apartment would have cost at least 600,000 yuan. It's important to note that these houses were originally bought for 600,000 yuan from real estate companies, but due to the drastic drop in prices, they're now being sold for only 60,000 yuan. This massive price difference is the gap that has swallowed people's cash. Zhangjiakou's housing prices are particularly notable because the city is quite close to Beijing. Zhangjiakou is about 193 kilometers from Beijing, and a high-speed train from Beijing's Qinghe Station to Zhangjiakou's Xiahuayan Station takes just 40 minutes. For this reason, many people who can't afford to buy a house in Beijing look to nearby provinces and cities like Zhangjiakou. It's a popular location to buy homes for Beijing's working population. Chen Juan, the real estate agent mentioned earlier, said that many people buying houses in Xiahuayan are from Beijing. Additionally, there are families from Shandong, Inner Mongolia, and other places who have only children working in Beijing. To be closer to their children, these parents buy homes here. Others simply can't afford a house in Beijing and want a place to stay on weekends. Despite these advantages, Zhangjiakou's housing prices have still plummeted. One person commented online, "I really can't stand it. A prefecture-level city, only 40 minutes from Beijing by high-speed train, and the housing price is only 1,000 to 2,000 yuan per square meter. Is the economy collapsing, or is there a massive population outflow?" Chen Yao, Vice President and Secretary General of the China Regional Economic Association, believes that the sharp drop in Zhangjiakou's housing prices was expected. Urban development relies on industry, and Zhangjiakou simply cannot replicate other cities' real estate policies. It needs more attractive policies. In an effort to save the housing market, the Chinese government has introduced what's known as the 517 New Policy. This policy includes three main points. First, the nationwide minimum interest rate policy for first-time and second-time homebuyers, commercial personal housing loans has been explicitly cancelled. Second, the down payment ratio has been lowered. The minimum down payment ratio for residents' first commercial personal housing loan has been adjusted to not less than 15%, and for the second home, not less than 25%. Third, they reduced the interest rate on housing provident fund loans by 0.25 percentage points. The adjusted interest rate for personal housing provident fund loans for first homes over 5 years is now 2.85%. After the announcement of this new policy, it was implemented in many cities across the country. First-tier cities are actively following suit to save the housing market. For instance, Shanghai's policy differs slightly from other regions, with the minimum down payment for the first home reduced to 20%. Guangzhou also issued a notice aiming to stabilize the housing market. Many of its provisions exceeded expectations. Despite the government's efforts, the real estate downturn persists. Investors remain skeptical about the CCP's relief measures, doubting that Beijing's support is sufficient to halt the decline in house prices. As a result, Chinese real estate stocks have fallen nearly 20% from their peak in May, entering a technical bear market. One online commentator joked that the CCP's rescue measures were useless and that real estate stocks quickly performed a return to the starting point routine in just 20 days. Bloomberg's analysis of the China Developer Stock Index shows that Chinese real estate stocks fell by 3.3% on June 6. Since mid-May, they have accumulated a decline of nearly 21%. Among them, Sunac had the largest drop at 12%, while Sci-Fi Holdings fell by 8.4%. Initially, many investors welcomed these policies, especially the reduced down payment requirements for homebuyers. However, they later began to doubt the effectiveness of these policies in reviving demand and addressing the housing surplus. With skepticism about the relief plan, real estate stocks have been falling back after reaching their peak. Moreover, there are concerns that the scale of these measures might be insufficient. Despite Beijing's announcement that the central bank plans to provide 500 billion yuan in bank loans to support buyers, this amount is a mere fraction compared to the total value of vacant apartments in China. Jeff Zhang, an analyst at Morningstar, said, according to the latest sales data, the new home sales of the top 100 real estate companies fell by 33.6% year-on-year in May, compared to a 45% decline in April. There hasn't been much improvement in the fundamentals. We might have to wait until the end of the year to see the decline narrow or monthly sales rise due to the government's rescue plan. Joy Young, founder of Shenzhen Infinite Fund Management Company, stated that they are currently only making short-term investments in Chinese real estate stocks because the fundamentals of the industry remain weak. Another stockholder who invested in real estate stocks commented on Weibo, saying that he is now admitting defeat and exiting the market. He warned those with similar expectations. You must not drag it out thinking I'll wait and see, I'll buy more to average down, or I'll break even. If you see any positive signs, sell quickly and leave the market. He also mentioned that no one dares to have any illusions about real estate anymore. Any delusional thoughts will lead to irreversible disaster. The dire state of the real estate market has significant effects on its upstream and downstream industries, especially regarding the financial chain. Concrete company owner Ning Zhiguo has been in the industry for 20 years. He believes that besides the slump in the real estate sector, operational issues within concrete companies could also lead to their mass closures. He said,
In the past, was the construction industry profitable? Definitely. Especially before 2016, it was extremely lucrative. When the real estate market was good, concrete mixing plants also thrived. But now, with the real estate market in decline, we're also facing tough times. We invested over 10 million yuan in our mixing plant, and making 3 to 5 million yuan annually was considered good. The investment returns were high due to low initial investments. However, there were risks, such as accounts receivable and payable. Healthy receivables are crucial. If they turn into bad debts, It's a disaster. In the past, concrete mixers were like money printers because the industry was so profitable, especially in the early 2000s. Now, with the market downturn, everyone is struggling.
Where do these bad debts and delinquent accounts come from? They all come from real estate companies delaying payments. For example, Chinese real estate giant Country Garden has seen a continuous decline in performance since its financial troubles, affecting its ability to repay debts. According to reports from Housing Finance, Country Garden released unaudited operational data for May. Country Garden received shareholders' equity sales of 4.29 billion yuan, a 76% drop from last year's 18.2 billion yuan. Equity sales area was 440,000 square meters, down 80% from last year's 2.26 million square meters. For the first 4 months of this year, Country Garden achieved shareholders' equity sales of 13.5 billion yuan and equity sales area of 1.38 million square meters. Thus, the cumulative shareholders' equity sales for the first 5 months were 17.8 billion yuan, an 84.2% drop from last year's 112.8 billion yuan. Cumulative equity sales area was 1.82 million square meters, down 88% from last year's 14.7 million square meters. Country Garden has yet to release its 2023 annual report. Country Garden explained, "Due to the continuous fluctuations in the industry, the operating environment the company faces is becoming increasingly complex. The company needs more time to gather sufficient information to make appropriate accounting estimates and judgments. Therefore, out of prudence, the company expects it will not be able to disclose the 2023 annual report on time." The underperformance in sales naturally affects Country Garden's debt restructuring. According to the paper, Country Garden plans to postpone the interest or principal payments on 3 debts due before September to sometime in September. Earlier, Country Garden had stated that due to the sales recovery falling short of expectations and capital allocation pressures, funds were not fully in place, and they would make every effort to raise funds. On May 9th, Country Garden Real Estate Group Company Limited, a subsidiary of Country Garden, announced that it would do its best to pay the interest on 23 Country Garden MTN 002 and 23 Country Garden MTN 001 within the 3 working days grace period. Regarding the use of grace periods, Country Garden has declared that due to continuous industry fluctuations and an increasingly complex and severe operating environment, the company is making every effort to raise funds. However, due to the sales recovery falling short of expectations and difficulties in fund allocation, it cannot make timely payments. Among these debts, how many are bad debts and uncollectible receivables from concrete companies? How many of these debts have directly led to the collapse of concrete companies? In fact, it's not just Country Garden experiencing significant sales declines in the first 5 months. The sales performance of China's top 100 real estate companies is also declining. On May 31st, third-party consultancy CRIC reported that China's top 100 real estate companies achieved a sales value of 322 billion yuan, a decrease of 33.6%. Monthly performance continues to remain at historically low levels. Cumulatively, from January to May, the top 100 real estate companies' sales amounted to 1.41 trillion yuan, a year-on-year decrease of 44.3%. Expecting real estate giants like Country Garden and Evergrande to repay their debts by boosting performance seems very difficult. The first reason is that no one wants to buy houses anymore. With housing demand saturated, the sales volume of houses primarily relies on speculators. As housing prices continue to fall, speculators stay away from the market. In a market clearly oversupplied, the number of home buyers gradually decreases, making the decline in house prices inevitable. Combined with an economic downturn, people lack the funds to buy homes, reducing the desire to purchase and directly impacting real estate companies' sales revenue, which in turn reduces the amount available to repay debts. The second reason is falling house prices. When houses cannot be sold at the expected price, they might eventually have to be sold at a loss. This exacerbates the already low sales performance of real estate companies, with sales volume and revenue both declining. In this context, renowned Chinese macroeconomist and director of the Shenzhen Daguan District Financial Research Institute, Unsold, provided his forecast.
House prices will definitely continue to fall, and this won't change in the short term. This is the reality in China today. Ultimately, houses are meant to be lived in. If no one lives in them, they are just piles of waste. I can responsibly say that the investment value of Chinese real estate has significantly decreased. If you still want to buy a house now and expect it to appreciate by 50%, 100%, or even several times in 1 or 2 years, that possibility no longer exists. In very few locations, there might be exceptions, but in most parts of the country, this trend has reversed, and house prices will continue to fall. The fundamental reason for the ongoing decline in house prices across China is a significant drop in our birth rate, which is a core issue. It will not change in the short term. A few days ago, I met a young person who said, "I don't need to buy a house. My parents have several houses, and my husband's parents have several houses. We have houses that no one lives in, so why buy more?" If this situation is widespread, house prices cannot rise, and investing won't be profitable because there are too many houses. I can confidently say that those who bought houses to make money in the past will not profit anymore. More alarmingly, houses could become worthless, and your asset value could drop to zero. This is a reality. If you have bought a house with a loan, it could become a negative asset, and many people are already heavily in debt because of this.
Downstream industries in real estate, such as concrete mixing companies, are destined to fall as well.